Breaking the Mould, our regular look at the financial markets with our investment director, Russ Mould. Russ, how are you?
I'm very well, Clara. How are you? It was lovely to see you again.
It's good to see you.
It's a pleasure.
I've missed you.
Well, I missed you too. So there we go. Well, you've been Paris somewhere.
Yeah,
City of Light. How lucky is that?
City of Love as well.
Yeah.
Russ, what's the fuss?
Okay, well, we've got an absolute blockbuster of a week coming up. In fact, there's so much going on, it's kind of hard to know where to start. With 17 FTSE 100 firms publishing results or trading updates, and there's a big batch of macro releases as well. But, quick pause for breath. For me, the real fuss in the next week is going to be caused by third quarter results from BP and Royal Dutch Shell on the 27th and 29th, respectively. Third quarter figures from drug giant GlaxoSmithKline, there on the 28th. And then on the macro side, to cap it all, we've got third quarter GDP numbers from the UK on the 27th, the latest interest rate decision from the US Federal Reserve, and that's on the 28th. Then third quarter US GDP numbers on the 29th.
I don't know how we're going to pack that all in, so I better cut the chat and get cracking with this. Should we start with big oil?
I think we probably should. I mean, in the end, given the importance particularly of income to a lot of you people watching, these are going to be really, really big stocks. So weak oil prices, worries over the global economy have both been top-down worries for BP and Shell over the last 12 months. As you can see from their share prices in this chart here, BP's first on the left-hand axis, Shell's on the right, but trend's kind of the same. Now, the headline numbers really aren't going to look that flash, as the consensus analyst has got stated profits more than halving for BP and Shell for the full year as a whole. So the focus is going to be much more on how they respond to this in terms of cost cuts, capital investment, budget reductions and asset disposals. This is because all of those adjustments could help boost earnings, but certainly help cash flow, so those chunky dividend payments have got more cover than they have right now.
Okay, so what are the key numbers to watch out for?
Okay, well, that's pretty good. I mean, BP is expected to pay 10 US cents a share for its Q3 and Q4 dividends, the shareholder distributions, to make a full year figure in sterling terms of around 26 pence. Now, that yield is around 7% on the current share price, just under, but if oil doesn't rise, BP's going to have to work jolly hard to fund that from self-generated cash and not use debt to fund that distribution. Same story at Shell, although the dividend cover here, bit better, just above 1 times rather than just below as it is at BP. Now, for each firm, the next chart shows the consensus analyst forecast for earnings and dividend per share figures for this year and next. BP this side, Shell that side. Now, it would be nice to have just a little bit more comfort here. Remember, BP does have form, cut its divvy in 2010 and actually in the 1990s, though Shell, so far as I can tell, hasn't cut its dividend since at least 1945.
Wow. Okay, Russ, that is oil. Should we move on to pharmaceuticals?
And that means third quarter numbers from GlaxoSmithKline on the 28th. Another poorly performing but fat yielding stock. And again, where earnings cover is just a little bit thinner than you really like it to be. Here's the share price chart, first of all, fairly self-evident, it's not done that well. And then here's a graphic showing earnings per share and dividend per share over the last 5 or 6 years. Note how profits peaked in 2011 on a stated basis, and the dividend cover, the line on the right-hand axis, is sinking nearer and nearer to 1, when really you'd like it to be nearer 2, and in fact then some. So the key issues to watch with GlaxoSmithKline's Q3s, a sales momentum across the 3 units, pharmaceuticals, vaccines and consumer healthcare, cost-cutting progress, and also how the company's drug development pipeline is going as a huge deal with Switzerland's Novartis beds down. For the full year, boss Andrew Whittish predicted double-digit percentage drop in earnings per share and an 80p dividend, along with a double-digit percentage increase in earnings per share for next year. So that's sort of the 3 benchmarks.
Okay, really quickly then, should we finish off with macro and these big central banks?
Yawn. Keep it really quick. I mean, you know, yes, UK and US Q3 GDP numbers, they're backward-looking, and markets are forward-looking discounting mechanisms, and they're already worrying about 2016 and 2017 earnings. So we can't get too hung up on them because they are third quarter and backward-looking. But just in case you're interested, consensus for the UK is quarter-on-quarter growth of 0.5%, down from 0.7% in Q2. For the US, now this is probably the more interesting one, the consensus is 1.8% annualized growth, down from 3.9 in Q2. But the Atlanta Fed GDP Now survey, very influential, is expecting less than 1%, so it's way below consensus. That slowdown may explain why the Fed's yet again been holding back on interest rates, and it may again not do anything when it meets on the 27th and 28th, leaving it with just the December meeting to deliver that long-awaited interest rate hike for 2015.
And breathe.
And breathe. Thank you.
Thank you all for joining us. We'll see you next time. Goodbye.